Chapter 3 discusses the organization, components, purpose, and limitations of the income statement. After completing Chapter 3, you should be able to explain how the multiple-step income statement is organized, describe the accrual basis of accounting, revenue recognition, and the matching principle, compute and interpret profitability ratios, interpret trends in income statement revenues, expenses, subtotals, and totals, and prepare and interpret trend and common size analysis. This statement is also called statement of income, statement of earnings, statement of operations, or profit and loss statement, or simply P&L. The income statement helps users of financial statements to evaluate past performance. How much was the revenue? Has it grown from previous years? Has management operated in an efficient manner, that is, with the use of fewer resources? An analysis of revenues and expenses and how they change can help us determine that. If sales have grown but expenses haven't at the same rate, that would be a sign of efficiency. We can predict future performance based on past performance, and we can determine the risk or uncertainty of achieving future cash flows. Information about the various components of income is helpful for assessing the likelihood of achieving a particular level of cash flows in the future. It would be a favorable sign if sales increased because they result from an ongoing operations. If there are no significant changes in the economy or company's operations, we can expect to see them next period as well. However, if these increases are from gains, as non-recurring transactions, we should be worried because we may never see them again. In the case of the second scenario, there will be no income to cover the expenses incurred. As we analyze the income statement, we should be aware of its limitations. One of them is items that cannot be measured reliably are omitted from the income statement. For example, the value of brand recognition, customer service, and product quality are not part of the financial accounting. Another flaw is income numbers are affected by the accounting methods employed. For example, a company's results will be different if a company adopts FIFO instead of LIFO for inventory valuation. When comparing companies, you should make a note of any differences in major accounting methods and make adjustments for better comparability. Another flaw is that income measurement involves judgment. Some companies tend to be more aggressive than others. This would lead to different results. The major elements of income are revenues, expenses, gains, and losses, as previously discussed in Chapter 1. The distinction between revenues and gains and expenses and losses depends to a great extent on the typical activities of a business enterprise. When the income results from a typical business activities, generally the activities the entity is in business to perform or its primary operations, revenues would result. Likewise, outflows or the use-up of assets resulting from typical business activities will cause increase in expenses. Here are the definitions. Revenues is income received from the entity's ongoing major or central operations. Some names for revenue accounts are sales, service revenue, fees earned. Expenses are used up resources in the effort to generate revenue, and some example for expense accounts are cost of goods sold, salary expense, rent expense, utilities expense, depreciation expense. Non-typical business activities resulting in flows or outflows of assets will generate gains or losses. Gains and losses result from peripheral transactions. For example, a CPA firm's revenue and expenses will result from its principal activities. Revenues for services provided such as consultations, audits, tax returns, etc. And expenses would be resources used such as salary, rent, utilities, supplies expense. If the CPA firm sells one of its old computers and it sells it for more than its book value, this transaction will result in a gain. If we sell it for less than its book value, then it will result in a loss. This is a peripheral transaction since the firm is not in business to sell computers. The income statement may be presented in single-step format or multiple-step format. Single-step income statement derives its name from the fact that total costs and expenses are subtracted from total revenues in a single step to arrive at net income. Income taxes are normally shown as a separate item among the expenses, usually last, to indicate their relationship to income. So what we will see on the statement, we'll see a list of all of the revenues, we'll add to them all the gains, then we'll subtract all expenses and we'll subtract all losses. This math will give us the bottom line or the figure for net income. The multiple-step format separates results achieved by regular operations of the entity from those obtained by non-operating activities. Expenses are also classified by functions such as cost of sales, selling, administrative. The multiple-step format provides more information to financial statement users than does the single-step format. However, both are found in actual practice. Thank you for watching.